Very good. It's 11 o'clock. So, to get going, we've got a bit of news first from me and Richard. Then we're going to be handing over to Andy Hattie, who's going to be talking over what happened during November. And then I'm going to be talking to David Smith from Henderson High Income. So, a bit of news from me first. Keystone Positive Change and Golden Prospect. Um, Keystone, we know, disaster. And since they sort of announced things been going on, their discount's been narrowing in, but it's still about 5.6%. And they've published a circular today to discuss how they're going to manage the end of the life of the trust. So the choice is between 100% cash or a rollover into an OIC, which is very similar to Keystone Positive Change, almost identical portfolios, but obviously it doesn't have any unlisted positions because it's an open-ended fund. And the open-ended fund is the default option. There's a constant message from the board, which is that Keystone would have been great if we'd only been given it more time. I think the jury's out on that, but that is the message, and so therefore they are arguing that they want people to roll into the open-ended fund and then reap the rewards when everything comes right again. The costs of doing all this aren't cheap. So it's £812,000, or about 1.37p per share. So that's coming off the NAVs of everybody, whether you're a cash exitor or whether you're an OIC switcher. But the way that it's structured, the cash exit is at a 1% discount to effectively former asset value. And I don't understand that. And actually, I'm quite upset about it. I don't think that is a fair way of approaching this, to be honest. I really think that cash exit should have been a former asset value. So the unlisted things is what complicates everything. They have sold one of them. That's a great help. Norfolk's gone bust, which sort of takes that out of the equation, really. They're still sort of talking as though there might be something recoverable for it, but I think it's instructive that Goldman Sachs has written it off completely. The ones that are left, Climeworks, I'm really not sure about. But there it is there. They think they might be able to sell it. But the whole idea of it is that you set up some big machines in Iceland that actually take carbon dioxide straight out of the atmosphere by filtering it, which is an extremely inefficient process, and then pump it underground where it combines with basalt. It clearly only works for if it encourages enough subsidies and stuff. I mean, there's no economic logic to it at all. PsiQuantum, quantum computing, they are busy building proper utility scale quantum computers. There's definitely one in Australia. I think there's another one in the States. That I think is probably more sellable. And then the other one, which I think is really interesting, is Spiber, which is making man-made fibers from plant ingredients rather than sort of petrochemicals. I'm not sure how the cost competitive that is or not, but that just actually seems like an interesting business. And again, so there might be sellable too. So basically, all of these things get put into the liquidation pool and then get turned into cash over time. And that might take a long time, or it might be done really quickly. We just don't know. The meetings to approve all of this are in January and February. There needs to be two, but you won't be able to deal in the shares after the 27th of January. You're able to trade in the OIC until the 10th of February, and the cash option won't pay out until the 17th. So my inclination would be to switch into the OIC and then immediately cash that in. There's no exit fee on the OIC. But they do adjust it to reflect the outflows, but they're really only doing that to reflect the costs of dealing. So I think that's probably going to be a sort of a fair price, and then you don't lose that extra 1%. But there we go. Golden Prospect, very quickly, really quick on this. It's still tiny, even though after this subscription share thing that's had the discount's about 23% at the moment, and they see that's been widening out. This all relates to the subscription shares. So these are embedded within the company. They're not a separately traded thing. They give you the right to buy shares in the fund at the previous year's NAV. This time around, the exercise price is 35.94p. And because that was they were in the money, but not very much. So roughly half and half exercised and decided not to. The interesting thing is that because it's only marginal now, because the share price has come down, I think in anticipation of the subscription trustee exercising those 9.4 million rights and then trying to place those shares in the market, because that's not going to happen. I think the share price will now go back up again. So basically, it means that if you took up the rights, and I did, and I think probably sure a few other people did, then you bought these shares at 35.94p, and I think the share price is going up from here. If you didn't take them up, you'll just missed out completely, and you've just been diluted. But there we go. Next year, the rights price is going to be 48p. If we get into a position where people want to exercise that, that's all good news. Right, now I'm going to hand over to Richard.
Thanks, James. Just a quick one from me on home REIT. So shareholders have been given the option to tender their shares at 4p this week, which was quite a surprising move. So Selby Capital, who I've never heard of, but I've looked them up. They specialised in distressed securities and liquid securities. So this is sort of right up their street. So they've offered 4p, which values the whole company at 32 million. They don't want to they want to avoid the mandatory takeover, so we'll limit the acceptances. But they say it offers shareholders, obviously we know the story on this, an opportunity to get out while they can. There's a lot of sort of uncertainty of how much they'll get at the end of this, when that will come because of the sort of litigation, stuff like that. So the offer expires at the end of December, so we've got a bit of time to think about this. So they're currently in a managed wind down. They've been selling off some of the sort of run of their portfolio at auction, and that's come to a close. They've now got a portfolio of about 850 properties, which they are marketing, and they're hoping to get 175 million. Whether they will remains to be seen. And they'll return that capital to shareholders once that's completed. Again, the 850 properties, they'll probably want to sell that all in one batch to someone. That's going to have an impact on the price and things like that, and it's going to take a while. So it's uncertainty on timing on that. But last week, it finally repaid all of its debts to Scottish Widows, who then charged them another 9 million to sort of release its charge over the portfolio, which they will pay through there's a portfolio that they sold recently at auction, which hasn't completed yet, for about 17, I think it was. So that will pay down that, and they'll have a bit of money left over, which will probably cancel out the estate agent fees that they'll pay on selling the properties. So you can sort of back it out, 175 million. The NAV based on that is about 21p. But then obviously you've got all of this stuff coming up, which will take a lot off of that. So yeah, so they've got shareholder litigation against them, which they're fighting. They're also suing the former manager, and they're facing this FCA investigation. So all that's going to take up a lot of time and money, and they've still not published their up-to-date accounts. So we also had yesterday at their general meeting, shareholders refused to approve the historical accounts from 2022, which means the company now must consult the shareholders. I think they've already done that pre all of this. For the reason of rejections, it seems to me to be a protest vote, because it's all sort of a new board and everything like that. I can't see them wanting to oust the new board while this all goes on. So it seems to be a protest vote. But the accounts from 2023 and 2024 are still to come. So they say they're going to report on the accounts for 2023 by the end of this year. So that's in the next couple of weeks. and then the accounts for the 20 to the end of August 24, they hope to publish it by the end of the first quarter of next year. So that's when shares will start trading again. And then we'll see where the share price drops to when that happens. On the next slide, James, just a couple of points. Yeah, so and that will also provide the updated NAV, so we can work out exactly how much we think this company's worth. It's going to be more than 4p, so I'm not sure anyone should really take this tender offer. People might just want out and get some money back, and that's probably what the Southie are sort of hoping for, really. But yeah, I would wait if I was a shareholder until we see more sort of visibility on what the value of the company is, and how this sale process will go.
Cool, thank you. I mean, the really frustrating thing with this is that those accounts were supposed to be all published by the end of the summer, by the end of September, and now we're into the first.
Yeah, and they've not really given a reason why.
No, exactly.
So,
no wonder people voted against. Anyway, let's hand it to Andrew.
Thank you very much indeed. I mean, that is a horrendous situation, and I must say the word that springs to mind for me from that tender offer is opportunistic. But there we are. We'll see if anybody fancies it. I think we probably need a bit of cheering up after that. So let's have a look at the rises over the last month, which were actually quite good. There were quite a number of very significant rises, quite a number over 20%. At the very top, we have the continuing strange situation of JP Morgan emerging MES securities. If you remember, that was the old JP Morgan Russian securities, which has a lot of Russian assets that were written down to zero. And it still owns them. And so there's some hope that it might be able to recoup some value if relations thaw and there's some resolution to the Ukraine crisis. But beneath that, there are quite a lot of rises, which also I think relate to very much the same issue, which is the US election. And the clear result there, I think, has boosted a large number of trusts that have their holdings in the US. You'll see Bailey Gifford US Growth there with a rise of 27%, JP Morgan US Smaller up 23%, and a number of other trusts where their main holdings are in the US have all been boosted very significantly. So I'll talk about that in a moment. And on the downside, the fallers were not as pronounced, which is quite common. There's one big one at the top, which was Hydrogen One Capital Growth, and that suffered because of the failure of one of its investments called HH2E, which was a German green hydrogen developer. That went bust, and that took out about 11% of assets there. But nevertheless, a very significant reaction to that, which I'll also talk about, because I think the common theme amongst the fallers here, again, a very clear, broad theme, is that renewable energy has really been suffering and has been derated yet again. So I'll talk about that as well. So the US Focus Trust, first of all, I think I'd like to be a bit more sophisticated about it, but actually this was easily the prime driver of what happened to markets. And in a way, it was very simple, that the right-wing candidate won, and that means the potential for lower taxes and less regulation. It was a clear result, which the market had been very worried about. And also, I think perhaps the market hadn't really thought about the positive consequences of that, because I had a lot of manager meetings before this where the subject of the presidential election arose. And I think in all of those meetings, the questioning was all pretty negative. It was all about what might happen if it was a bad result, what the implications of a Trump presidency could be for international trade, how it could upset markets, whether there was scope for any civil unrest, actually, if there was not a clear result. And it was all quite negative. So the fact that there was this very clear result, I think boosted markets very directly and considerably. You can see from the two charts here, we've got the S&P on the left and the NASDAQ on the right. These are 1 month charts, and both of these indices shot up. The S&P by about 5.3%, NASDAQ by a bit more, as you'd expect. So a very significant rally in US assets. And as it happened, I talked about Baillie Gifford US growth last month, which had already made up good ground. And I think that was rather underestimated by the market. It had crept up without people really realizing. Obviously, that's a very tech-heavy portfolio that had benefited, I think, in an outsized way from this rally. And so that's been wonderful news, actually, for anyone invested in Baillie Gifford funds that's been suffering for the last couple of years. But I think it's such an interesting point in the market now. And the question is, after this inflection point, is this rally going to be sustained? Or, in fact, in the cold light of reality, after this knee-jerk reaction, are we going to see the market pull back? Because actually, inevitably, politicians overpromise and underdeliver when it comes to elections. So we'll have to see how these early months of 2025 play out. And I think it's quite interesting. I'm not sure we're going to see a continuation of this rally, particularly as it has driven the US market up to quite a high valuation. And this is something I keep hearing from fund managers over and over again, particularly those who are not invested in the Magnificent Seven and are not really benefiting from this. They point out the high valuations and say, well, it's looking quite risky now. And the counter argument for them is that actually, because so much money has been flowing into the US and into the Magnificent Seven in particular, that means a lot of other markets have been ignored and overlooked and are on lower valuations. So there's a lot of opportunity elsewhere. Just a couple of quick tables. The one on the left actually is from a very good source I have, which gives me the returns of all overseas markets, including all of the small ones. And in the year to date, you can see there's Argentina at the top and a couple of other emerging markets, which is what I would expect. But actually, it's quite telling, I think, that both the NASDAQ and the S&P 500 are on that list of biggest riders. So this has been a very significant rally in the US. It really has stood out amongst all of the big global markets this year. And on the right-hand side, we have a list of price earnings ratios. And obviously, these can be calculated in slightly different ways, so you have to be a bit careful with them. But after New Zealand at the top, you have the US. It's about 26, 27% PE, which is quite rich, I think. Above India, and we've talked quite a lot over recent months about the high valuation of Indian equities, and also Switzerland. And a couple of weeks ago, I was talking to a European fund manager who was talking about his allocation across European markets. And he said the one market he won't have any money in is Switzerland because of the high valuations. And the US is significantly higher. So I think there is a bit of a risk element there. And because of this higher risk, I think you'd have to regard the US as quite a punchy bet at the moment. I don't know whether it's going up or down, but I think you'd have to say it's quite geared. And so you don't really want to have extra gearing on top of that from your US investment trusts. I'd be a bit wary of that. So I just had a look at the gearing levels, and actually I can see, and you can have a look in the column here that I've highlighted, the gearing levels are actually pretty low across the sector. And two of the higher ones actually are on Baillie Gifford US Growth and JP Morgan US smaller companies, which were towards the top of that list of risers. But nevertheless, I think the gearing here is quite reassuring because it's not excessive and you're not layering more risk on the risk of the market that's already there. So I'll be watching the US market very closely as 2025 arrives, I think. And on the downside, we had quite a contrast, actually. The other big political event of the month, really, was, of course, the UK budget, which we'd been keenly waiting for. And I think the outcome was quite disappointing there for the market because the shift in the fiscal rules and the extra government borrowing, I think, did spook the UK gilts market a bit. And this chart here is the UK gilts yield, it's 10-year gilt yield. And you can see actually, it's hard to see the dates, but this is basically the last month. You can see that gilt yields rose quite sharply actually after the budget, but they have fallen back since. But what is interesting is that that rise in gilt yields, I think, was then expressed and reflected across the investment trust sector, with high yielding investment trusts being hurt by that, and their prices came down, but they haven't recovered as the gilt yield has softened again. So I think potentially there's a little bit of a lag here and an opportunity. And certainly renewable energy investment trusts, I think, are one area where the discounts are really quite astonishingly wide now. Again, they've been highlighted in this table here. And you can see it's a sector-wide phenomenon. This is not because of problems at one or two specific trusts. It's right across the whole spectrum, including the higher quality trusts here. So I think there's a lot of value embedded in this sector. And if you look in the next column as well, the dividend yields are really very enticing here. Clearly, it's very important to look at the sustainability and the prospects for growth there, but you're able to obtain double-digit yields here from some pretty good trusts, I think. So I feel there's quite a lot of value in the sector at the present time. But we've got to, I think, await a change in sentiment, because my strong sense is that investors are extremely skeptical about this sector at the present time. They're very hesitant to invest, and the sentiment is really overwhelmingly negative. And in various meetings I've had in the last month, I've seen this over and over again. And I've got three examples here. The first one is that fall in hydrogen one capital growth, and also Foresight Environmental Infrastructure, which had 2.6% of its assets in this German energy developer. Now, they were both marked down very heavily. To some extent, I can understand it with the Hydrogen One Capital Growth Trust, because it indicated that perhaps the hydrogen market is not developing quite at the pace that everybody had hoped. I think as well, because Hydrogen One Capital Growth was a secondary investor here, it doesn't have the power and the agency of the larger investors, because it was actually Foresight that took the decision to stop funding the developer and let it fail. So I can perhaps understand why the reaction there was quite strong. I'm slightly more puzzled by the fairly big fall in the Foresight's environmental infrastructure price. And I've met the manager subsequently who's talked through this with me. Actually, I feel the reaction's quite considerably overdone there, because that was the only development asset in that portfolio. The dividend is covered. The rest of the portfolio is very conservative. And so I feel, again, the market's probably overreacted to bad news. And the market's not necessarily reacting well to good news either. So on the 29th of November, we saw Harmony Energy Income Trust, which is one of the battery storage developers that's been trying to sell its assets, that provided an update to the market, which was quite positive, actually, saying there's been a lot of interest. They're going to announce, I think, later this month exactly what they're doing there and whether it's some single asset sales or the whole portfolio. But it sounded pretty positive, actually. And again, there's a very wide discount there. So there's good scope for some kind of uplift. I mean, I don't think you're going to get to the NAV, but some kind of uplift is possible. And when this was announced, actually, I noticed that the share price didn't move at all. In fact, I picked up a few more shares myself. And it took several hours, actually, for the price to move. When it did move, it actually went up about 10%. But again, the market wasn't jumping on this news with glee. And the last one, very quickly, SDCL Energy Efficiency, not that well known, actually quite a big trust. This had been sold off very heavily in the last 2 or 3 weeks, actually. It's really come down sharply. And then when it announced its interim results, they were actually, to my mind, very good. The NAV was up slightly. The dividend was completely covered. And again, we saw then a delayed rally on this. But the market's initial stance was that things were bad. and it had to be persuaded otherwise. So just to summarize, I think there have been plenty of problems and issues in the renewable energy sector, and those are continuing. So there are reasons for some degree of skepticism, but I think it really does look very enticing at the moment. A well-known phrase that's often dragged out on these occasions is that it's darkest before the dawn. So we'll hope that's the case. With that, I'll hand you back over. Thank you.
Thank you very much indeed, Andrew. I agree with a lot of those sentiments, and yeah, I've got some of those shares as well. Good.